Today we are going to go through a post-mortem of a trade bust, and this is something that's been discussed here in TD in a couple of our channels, and there's also been a bunch of people on the internet that have been creating we've had the original person, let's just call him Dale, that's his actual name, a trader that had put on a particular type of trade, which are basically just out of the money call credit spreads, and stuff happened. He had a trade bust. A trade bust, by the way, is just when the exchange realizes that there was something wrong with execution. So in other words, a price that was crazy was executed, and then when that realization happens, they then say, nope, that was wrong, so we'll bust the trade. And busting the trade literally means like wiping it from history, as if that execution never happened. So whatever was before comes back to life. On the assumption that you were closing something off, it comes back to life. So that's basically a trade bust. It can definitely take people by surprise. It took this trader by surprise, for sure. And this trader then took an unexpected, slightly over $100,000 loss, which is clearly very ugly and is gut-wrenching when this kind of stuff happens. And today we'll basically be going in through to a very detailed post-mortem on this. Now, let me start by saying what is the objective here. The objective here is to purely look at facts and try to learn from this experience. I have been in the position where I've personally lost plenty of money in the markets through some mistakes. In my case, it was quite a while back from just following gurus blindly when I was, learning in my initial stages, and that to me was the final straw when I lost, a ton of money from following these gurus blindly without truly understanding what I was doing, and that led me through to moving away from that path and really needing to learn how to do stuff myself. But I've been in that position where you just lose a ton of money and it rips you apart, you feel terrible. I definitely feel for Dale. I know what it's like to be in his shoes, and it's horrible. That said, there's a lot of information going around on the internet now where there's people saying, oh, CBOE screwed him, or Schwab, which was his broker, completely screwed him, and how dare they, and this is an injustice, and let's organize rallies, and let's contact Congress people, and blah blah blah, and let's put money together for Dal because he's been totally screwed, and blah blah. So there's a lot of that going around, and my objective here is to, again, purely look at facts without taking anybody's side. Okay, I'm not going to take CBOE's side, I'm not going to take Schwab's side, and I'm not going to take Dale's side either. Even though I've got compassion for Dale, and I feel for him, right? I feel horrible. I know what it's like. Nobody wants to be in that particular position, but we need to try to learn from what happened. Okay? If you go through pain, it's a waste if you don't take time to think about what went wrong, to properly analyze stuff, rather than simply having someone pat you on the head and say, oh, poor boy. Okay? That's not the objective. That doesn't help. What helps is to figure out what went wrong, were mistakes made, what were the rules, and how do we avoid this situation for ourselves so that we don't run into the same problem and go through this horrible experience of what Dal has gone through, which is losing money. Nobody wants to lose that, and especially losing a ton of money. So that is where I'm coming from, and I'm going to purely focus on facts, and that's it. Now, the other thing is that the slides, due to the fact that this is basically a post-mortem, it's going to be very data-driven, and therefore the slides are going to be a lot more text-heavy than what I'm personally comfortable with. So I apologize in advance for that. Okay. All right. So let's get into it. Starting up, we're going to look at what was the trade that was done. So this trade was placed on April 9th, 2025, 10:30 a.m. Central. I've mentioned that the trader's name is Dale, and he basically just sold 10 call credit spreads. Okay, you'll sometimes interchangeably hear me calling them a vertical. That's just another common name for it, but it's basically just the call credit spread. That's the acronym. You'll see this acronym throughout the slides as well, so don't get confused by that. And so he basically had his shorts at 51.65 and his longs at 5200 here. The shorts were at 591. Longs over here were priced at $3.51. This was a 0 DTE trade. And so based on this particular width, you can see that that was a 35-point wide call credit spread, which was out of the money. Now, the credit received per spread over here was essentially, well, $2.40 on the spread itself, but then with the contract multiplier of 100, that gives you a credit of $240 per call credit spread, and he was doing 10 of them. So that therefore implies that he got a credit of $2,400 for his 10 lot call credit spread. The max risk on that particular trade for a vertical here is, well, in this case, it's really just the width, which was the 35-point wide width there, minus the credit received over here, which is basically this amount of money here. So it's 35 points minus 2.4, right, which is the contract level credit received per call credit spread, and that comes through to 32.6. Multiply that by the contract multiplier in SPX, which is 100. That basically means that he's got a risk of $3,200 per call credit spread. So on 10 call credit spreads, he's got a total risk of 32.6K. I've reviewed every YouTube video that I could find, which were basically 3. Here, actually, well, 4 if you count a podcast. So, but basically, I've reviewed everything that I could see on the internet in terms of existing reviews, and primarily by Dell. Okay, so this is Dell getting on and fully explaining what happened, and of course he's doing this to try to get the word out that he was screwed by and it's all unfair and there's been an injustice and blah 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 blah. So which I understand, that he's doing that from his perspective. But again, we're just going to focus on facts today. Now, in those explanations of him describing the trade, in no video did he mention anything about any kind of max planned loss level. I don't know for a fact if he had one, but the fact that this is a 0 DTE trade, I can tell you that you don't go about adjusting these types of trades when you're playing in 0 DTE land. Most of the time, the trades that you put on are going to be slap on, slap off type of thing. So you can't do the types of things that we would normally do in our community where, we're making adjustments day by day, that kind of stuff. Forget about all that. It's basically typically a slap on, slap off type of trade. And he mentioned no planned max loss level. My assumption, therefore, is that he's in a situation where he is willing to risk this amount of money in order to make this amount of money here. So if you then convert that in through to essentially a ratio, he's basically willing to have a loss that is 13.6 times larger than the profit that he is hopefully looking to make. Again, very different through to how we normally do things. The thing that I typically teach is keep your planned max loss to about 2 to 3 times whatever your profit target is. To me, that's reasonable. That's the way that I like to do things. You can see this is very different here, but primarily because we're now talking about 0 DTE, right? There's no concept of making adjustments. It's slap on, slap off. The trader, Dale here, is saying that he put on a defined risk trade. So at this point in time, is that accurate? Well, yeah, it is, because he's basically putting on 10 call credit spreads and doing that as a single order. So that gets filled. 10 call credit spreads are on. That is a defined risk trade. Okay, so let's look at that and in terms of what this thing looks like visually. And we've got our 10 shorts over here at 51.65, and then we've got our 10 longs here at 5200. I went in and set my time. If you see my time over here, this is because I'm in Pacific and Dal was in Central. Okay, so he put it on at 10:30. I'm in Pacific, so therefore it's 2 hours earlier, right? So that's why you'll see that. And then once I committed the trade, I then went in through to the trade log and then went through and manually tweaked the prices here in order to make it exactly match what Dale had been filled on, which were the details that he previously gave. And we saw it on this particular slide, right? These numbers over here. Therefore, this is exactly the trade that he would have been trading over here. You could see that we've got our $2,400 amount of money that we can make if it expires anywhere from here down, okay? But you could see that we also have our 32.6K max loss over here if SPX goes from here to the upside and crosses this kind of threshold. Okay, at that point you've got your $3,200 loss there. So, but it is a defined risk trade. No matter how much SPX goes up, the maximum loss over here is going to be 32.6K. Now it's still almost 14 times the amount of money that he could potentially make, which I think is, well, it's not the type of trade that I like to put on, but it is a defined risk trade. Next step, once his trade is filled, he then goes in and he puts on a profit-taking order. We saw over here that each call credit spread over here had a credit of $2.40. Then I've referenced everything over here so you can validate everything I'm saying here, but basically one of the videos over here, you see the URL there from some dude called Speaking Greeks. And at time index 1523, Dal says, I normally close half of my spreads at 50% of the max value. Now he's putting on 10 call credit spreads. If he's saying that he closes half of his spreads, that implies that he's going to take profit on half of 10, which is 5. All right, so on 5 call credit spreads, he plans to take profit on that. When does he do that? When he's at 50% of the max, he calls it the max value, but basically he's referring through to the credit received, which is this guy over here. So when this is cut in half, so when this gets through to $1.20 for the call credit spread, he's going to take 5 of them off. That's how he described his trade plan. He didn't do that though, in terms of the order that he put in. He put in an order over here, not to buy back the call credit spreads for $1.20, which is what his trade plan, based on what he exactly said over here at this particular time index, right, would have implied. This is what his trade plan would have suggested, right? 5 call credit spreads, we take them off for half of the credit received at $1.20. What he did though is he placed a limit order over here on $1.20. So that part matches, right, in terms of this being half of this. But instead of putting on the call credit spread, he put it on the short calls only. So he's got a -10 and a +10 like this, okay? For the actual spread, the spread should have been shut down for $1.20. He's not doing that. He's taking this price over here, but applying it only through to the 10 shorts. Now, if you go back, you could see that the shorts over here were originally priced $5.91. This is $5.91. So if your trade plan is to now do something on the shorts, then if you're using this 50% kind of ratio, then that would imply that you want to sell off these shorts when they've lost half of their value. But then that would imply a limit price of $2.95, which is half of $5.91, not $1.20. $1.20 is half the price of the spread. And so that is one issue. The other issue is that instead of taking off half, like his trade plan said, he actually put on this limit order of $1.20 on all 10 of his short calls. That's not taking off half of your spreads. That's taking off essentially all of your shorts. That's a completely different thing to what he had specified in his trade plan. That is just me kind of being nitpicky, probably as a teacher, in terms of, you know, I always teach that whatever your trade plan is, you need to trade it. Okay? You don't make stuff up on the fly. Now, it's possible that he miscommunicated what he was saying here. The thing is, he miscommunicated this multiple times on every video that I saw. So I don't think it was a miscommunication. Regardless of that, this is just like a side comment. It's got nothing to do with the actual trade bust, right? Which we'll go into detail. So the two errors here, just based on a mismatch between his trade plan and what he actually did over here, I've already kind of covered, right? So instead of placing the limit order on the call credit spreads and only addressing half of the call credit spreads, he's putting his limit order on the shorts only at a price that does not match a reduction in half of that particular cost, because it ignores the cost of the long that's behind it. And then he's doing it on all 10 contracts instead of on half, which is what his trade plan claimed. Okay, so we already have multiple things over here that are not matching based on what his trade plan appears to be and what he communicated in multiple videos over there. So, but regardless of these potential errors, because I don't know for a fact that they're errors, it's possible he could have just miscommunicated what his trade plan was. But basically the point is that he's now got a profit-taking order to buy back all 10 of these short calls for a limit price of $1.20. That's where we're at. Moving on. This is just extra confirmation here of one of the sources. So this is the URL over here on Reddit. You could see here that he's basically saying, yes, I'm the guy painfully explaining it, blah, blah. So this over here is Dale. And you can see here that he's saying exactly the same thing again, that he sold each spread for $2.20, and then he created a profit-taking order here, which was a target of 50% of max credit, but the credit of the call credit spread, and then he's placing this as a resting order to buy to close all 10 of the those shorts, and then he's saying that 4 out of 10 of those contracts got filled, which we'll get to in a sec. But again, that's just extra confirmation that this is exactly what he did. Now, if you leg in or out of a vertical, the question, because remember, when you put on a vertical, that vertical did have defined risk. But now, if you place an order to, on a leg basis, now either remove or add through to any one of these two particular legs, do you now have a defined risk? Well, maybe not. So this is the first thing that we're going to start encountering, because even though we start off with a defined risk trade, which you cannot lose more than 32.6k over here, because remember, the whole point here is that at the end of this, we'll see that this trader has lost over $100,000. So you might say, what the hell? And this is exactly what he's saying. He's saying very much, what the hell, and I've been screwed. Because he originally put on a trade that had a max risk of 32.6, no more than that. And yet, how can he possibly lose $100,000? And that's what we're going to be exploring here. So the first little breadcrumb on the path to understanding this is seeing that he did not put on a order to peel off half of his call credit spreads. Had he done that, that would have been a defined risk move as well for that profit-taking order. And then we're also going to see how this could have eventuated if the call credit spread itself had been busted instead of the individual short, but this is coming up later on. Okay, so then over here I'm basically saying the scenario, what's the best outcome, in this scenario where the best outcome happens and you're able to get that profit taking order filled, what do you expect the underlying to be doing at the time? So in other words, what I'm saying is that you're putting on some call credit spreads, SPX is currently here. In the best outcome scenario where you're going to be having a profit-taking order that gets filled, what's going to happen? Well, two potential things. One of them is that SPX comes down, or the other thing is that time goes by. Now, this is, again, a 0DTE trade, but we'll see that his profit-taking order got partially filled 2 hours after he put it on. That's not sufficient time for this to really go that high. So typically what's going to happen is that you're going to expect SPX, in this particular case, to basically be coming down if your profit-taking order is going to fill. And on this particular day, what we saw was SPX massively going to the upside. So if SPX is massively going to the upside really fast, why would your profit-taking order fill? That does not make sense. Okay, but that's something to just think about, and we'll touch on this in a sec too. So now, remember, he's put on a limit order to buy back all 10 of his short calls for $1.20. And 2 hours after he puts the trade on at 12:20 p.m. Central, he gets a partial fill of 4 of these 10 contracts at the limit price that he had set, which was $1.20. And you can see this is his screenshot, apparently. And you can see $1.20 over here, 4 contracts over here to close. And he got that fill over here at almost at 12:20. Okay. So what was SPX doing at this time? It was massively going up higher. So that should have been something that made him go, I wonder why my profit taking order got filled if SPX is massively going higher. So if the market is ripping higher, do you expect a 51.65 option contract to be valued more or less? Well, clearly, if over here, if the market is coming to your option is increasing in dollar value. Just think of it, when the further out of the money you go, the cheaper those options are. And as the market now comes towards the strike that you traded at, it is increasing in value because it's now closer to at the money. So if he was in a position over here where his original sell price of his short calls was $5.91, and this is out of the money by a decent amount from where the market was, which was here originally, and now the market is screaming to the upside, this $5.91 is not going to go down through to $1.20, because when SPX is here, it's far closer to this contract than it was before. So therefore, the value of this contract has to be higher over here. Instead of being $5.91, it might now be 10, as an example. Okay, but it's going up, not down. It's going to be, it would go down to 120 if SPX went this way, and your out of the money contract now becomes really far out of the money, and therefore its value overall decreases. And that's basically what I'm saying here. So you originally sold the contract for $5.91. The contract has now jumped in value to around $17 at this point in time. Is that going to show up as a profit or as a loss for your position? Well, clearly it's going to be a loss because you're selling it originally for $5.91, and if you had to close this out, you then have to buy it back for $17. That's a loss. A pretty big one too. And then the other one is, what did the risk graph look like at the time? Now, this is a 0 DTE trade. So when you're doing a 0 DTE trade, if you've not done this before, your eyeballs have to be glued to the screen all day long. You got to watch your position like a hawk. Okay, stuff moves really quick in this kind of scenario. It's literally day trading. So was he looking at a risk graph? Is one of the questions. Now, he didn't mention if, because some people just like to trade based on so-called math. They just track the prices that they're getting for fills and put it into a spreadsheet or something like that, and that's how they trade. Okay, I think that's crazy if that's how you're trading. To forego a visual panel that provides a ton of useful information just by looking at a picture is kind of crazy, for me anyway, for the people that don't look at a risk graph. Okay, so, but I don't know. He's never mentioned anything about a risk graph. I'm hoping he was, but then we've got an issue, right? Because if he was, this is the picture he's looking at over here. This is where he currently is based on mid prices. Bid and asks are very wide at this point in time, or fairly wide, because remember, these prices reflect the assumption that you're getting filled based on mid if you were to exit your position or to work out your actual P&L. In reality, if you're going to have a fair amount of slippage, you're not going to be here. You're going to take a loss because of slippage. So overall, you might actually be down here. Regardless of that, even if you are here, you're now looking at a $22,000 loss on your initial fixed risk trade. This is, by the way, the original position of 10 call credit spreads. Okay, we're not yet looking at the fact that he had a partial fill on 4 contracts. But if he's tracking this visually using a risk graph over here, regardless of what software he's using, if he's just using the broker software Mind you, the broker software at IB for the risk graphs is just horrible. So you really do need to use something like this. But in his case, he was using Schwab. TOS has good risk graph analysis. So he should have absolutely been able to see this kind of thing in TOS and see visually that at the time that he was filled on this partial fill, his risk graph was showing he was down $22,000. That should be obvious from looking at this. Okay. The second thing is that when you then go through to the chain over here and you then eyeball the price, the mid price of this short strike at the time that he was filled, okay, at 12.20, there's only a 20-second difference over here. Option Leader Explorer here was showing a price of $107 for this short call. He got filled at $1.20 on this particular contract. How is that not a warning bell? So, was he looking at a risk graph? I don't know. If he was not, that is unwise. If he was, then, how do you miss this? The fact that your position is down very significantly, and the fact that your chain is telling you that the price is completely different through to the price that you just got filled at. This is just pretty much saying what I mentioned before, right? The risk graph, if you're looking at that, shows you at a substantial loss, and yet your profit-taking order just got filled. That has to be a warning bell to you. Then if we look at the matrix, we could see that the 51.35 strike over here was currently priced at 107, and yet his partial fill order here was for $1.20. And again, I'm just referencing the two things here, like the risk graph and the fact that the matrix is showing a completely different price over here. Plus also, if you scan through the prices over here to see if maybe, is this just like a mispricing of this one strike? Well, no, it's in line with all of the other mid prices from all of the other strikes that you see through here. $1.20 is nowhere near it. Okay, so 2 warning bells over here that should have gone off for, I think, a fairly normal average trader, right? Should have been able to see that kind of thing. So now let's talk about the situation where he has now been partially filled. So he's been partially filled on 4 of these short calls over here. If we go in and add these 4 longs, right, which he's essentially closing out 4 of his existing shorts, but it's essentially buying 4 long puts over here. If he's buying 4 long puts at the current so-called fair market price at the mid, this is what his position would morph to. So he originally had the call credit spread, which is the blue line over here, and his position is now morphed into a callback ratio. Okay, CBR. And this is what his position would look like based on normal pricing. Now, in his case, though, he's reporting that his platform was telling him that this was not necessarily what was going on, because he succeeded at closing 4 of these contracts, not at 107, but at $1.20. Now, remember, if he sold it at, let's round it up through to say $6 for this particular contract, and now it's at $107, they'd have to buy it back. That's a big loss. But if he can buy these 4 contracts for $1.20, then he's now making money on those 4 contracts. So therefore, the risk graph would, to him, potentially look different. So let's look at what that looks like. And before I do that, though, is the callback ratio here still a fixed risk trade? You would say yes. The possible total max risk over here now has deepened a bit. Well, I guess you could even look at this. If you were super unlucky, you could expire right down here, and this would be your max risk. But it's still defined. It's not like an unlimited downside. So it is still there. And on top of that, if the market is screaming higher, the market is going this way, and you're now on this path over here, are you that worried about having to rush to close things down? Well, no, because the more that the market goes higher, the more money you're going to make. You would be concerned, though, of the market kind of reverting back down. And in this case, you're now riding the curve down this particular way here, right? But let's stick through to what in theory he might have seen on his particular platform at the time, because he got a fill on these 4 contracts at a ridiculous price of $1.20 instead of 107 over here. And so what I've done here is, once I committed that adjustment of the +4 over here, you can see that the -10 has been reduced through to now -6. But then I went in through to the trade log and then tweaked the price of that particular contract through to $1.20 to make it match what his fill would have shown on his. And as you'd expect, it shifts that entire risk graph higher because of the fact that instead of taking a huge loss on that transaction of having to buy the 4 contracts at a huge loss, he's now actually making money on those, right? And also on top of that, the extra longs that he's got over here, they have massively increased in value. So the entire position is basically showing like a $20,000 profit over here based on his actual fill prices. Now, that can definitely be disconcerting if you're looking at your platform and your platform is telling you that you're essentially up money, but in reality you're down money based on fair pricing. So for sure that can be challenging. What does he do next? He then goes through, and as a matter of fact, let's just talk about what his position is. I'm just going to break this thing up and do it in chunks like this. So this is totals over here is -10 and +10, which are the 10 call credit spreads that he was trading. But let's just break it up like this. Now, what got filled on his side was essentially cancelling off these 4 short calls that he had. What it leaves in his account is a combination of this down here, which are 6 call credit spreads, and an extra 4 long puts over here, because 4 of these guys over here got filled by this partial fill. So this is his remaining position. So he's got 6 call credit spreads, still at 51.65, 5200. He's got a max risk of 3.2k per call credit spread, like we talked about before, and this is if SPX keeps going up, or stays where it is at that time anyway, because it had already moved up very significantly. And he's then got 4 extra long calls at 5200, which are these guys over here. And since he purchased it at $3.51 each, that's $351 per long call times 4, essentially, of risk if SPX now comes back down or closes below 5203. All right, so that is his position. What does he do? He actually then decides to go through and buys back to close all of those remaining 6 short calls that he had. So instead of shutting this thing down, because remember, and this addresses what Brandon was asking about before. So if you've got a call credit spread, so in his case he had 6 call credit spreads remaining, do you shut this thing down as a call credit spread? Now, the comment that was made is that if you're doing 0 DTE kind of trades and there is 0 value left over here in this long, then you're in a scenario that you can't actually shut down the call credit spread because you've got essentially no bids on the long. So therefore, as a spread, you can't shut it down. So you've got no option other than to go here and to close down just these shorts, and you just let these 6 guys over here just expire. That's fine. But that's in the instance that the back option has no value left. Are we in that scenario over here? This back option has a value of $83. Plenty of value there. So should you go through and close this down now as a call credit spread, or should you leg out? Well, remember, we just explained why you would leg out. That's only in the instance that your back option has no value left, and you can't close it because there are no bids there. If you were in a scenario that you close this thing out as a call credit spread, what is essentially the worst possible fill that you can get? Well, the worst possible fill would be the max risk that is possible on that particular strategy, on that call credit spread, which was the $3,200 per spread. That's a worst fill that you can get. If you leg out, though, at a time when the market is crazy volatile and there's value still in both of these legs, you're taking a big risk here. okay? Because you go in now, and now you've got to close down this particular leg over here. You're going to have significant slippage on that number one. Then you got to put in a separate order to do the same thing over here and close off these guys. You're also then going to have slippage on this particular leg, and on top of that, the amount of time between this trade and this trade that has happened. In this case, you'll see that there's only 1 minute of time went by, but the market was still screaming higher. You eat that by legging out. So you've taken slippage here, and you've taken the time differential here of SPX moving. All three of those you have to eat in terms of losses that you're going to take. Whereas if you just simply close out the entire spread, when there's value in both, so therefore it can be closed out as a spread, closing it out as a spread is a limited risk way of just shutting that thing down. And you know what your max so-called loss is, which is the width minus the credit received. But anyway, in his particular case, even though there was plenty of value in the back option, he's still going through and buying back to close all of those 6 remaining shorts that he had from these 6 call credit spreads. And then he goes through and also then exits the 10 longs on the back of those for 91.30 per contract. Okay, and you can see screenshots of his orders down here. So you can see this 6 to close at 153.50, and then over here 10 to close at 91.30. Third warning bell here. We've already covered the two, right? The risk graph and the option chain, basically showing very, very different information through to his partial fill, which should have alerted him to the fact that something's wrong. But we've got a third one here, and the third one here is that, remember, he's got a partial fill already on 4 of those short calls. He's then going and manually entering in this order here to get filled on closing out the rest of the shorts. He's getting filled at 153.50, where he just had a partial fill at $1.20. So even if you might say, well, you know, he didn't notice the original partial fill and he wasn't looking at a risk graph, which again, you've got to be monitoring stuff like a hawk on 0DTE trades. So, but even if you say that, okay, something weird happened and he didn't notice it, poor guy. Okay, he's now placing an order manually at 153.50, even though he just had a partial fill at $1.20. How is that not an alert for you? A warning bell that goes, I wonder if something's wrong. How can I possibly have been filled for $1.20 when the current price here that I'm manually entering myself now, there's no way he could have missed this. He's manually entering it for 153.50. Okay, I just don't see how that could have been missed. All right, but what do I got here? If your profit target order was either fully or partially hit, then why? Yeah, this is another thing. All right, so let's just look at this risk graph here. Remember, I mentioned this is based on the assumption that you can get filled at your mid price, but the reality is that you're very likely going to have some slippage, so you're probably going to be down here somewhere if you were to try to get out. Look at how far away you are from your total max risk that has already been defined. So this is without you doing anything, without you having to touch that particular trade. You know for a fact that your max risk is going to be $32.6 thousand. So if you're down here and the market is wildly moving and you know the bid-ask spreads are wide, why would you even want to try and close this thing down? You know that your max risk is this, guaranteed, without you doing anything. As a matter of fact, I think I've got a screenshot right here. So this is on the 6 remaining call credit spreads over here. This is where he was actually at the time that which is 10 minutes later, right? By the time that he managed to shut this thing down after the partial fill. And again, this is based on mid. In reality, he's probably down here once you're dealing with slippage. But look, he's like $2,000 away from his max risk for these 6 call credit spreads. Why shut them down? What's worse, he's then going in and legging out of this leg first to to close down these 6 over here. He's then got slippage on that. Then he takes 1 minute to place the order to shut down these guys over here. And then he eats the slippage on this. He eats the slippage on this, and he eats the 1 minute of time that SPX was rushing higher during this particular time. And he's got loss, loss, loss at a time where he could literally have done nothing and only suffered an extra $1,000 to $2,000 loss on these 6 call credit spreads. This is another hint to me that he likely was not even looking at a risk graph. Because when you're looking at a risk graph and you realize that you're down here, why shut this thing down? You're at max risk already. And I just don't understand how people don't look at risk graphs. If that was the case, I don't know that for a fact, but I'm just trying to put things together. And this is what this thing was basically saying, right? If you are basically extremely close to your max loss on a particular spread, no point shutting it down. You're already there. As a matter of fact, you could get lucky and the market could then reverse and your losses may be less. And in crazy kind of environments, if you then get a huge move back down, you might even come back to not having a loss at all on that particular trade. Piecing all of that together as well, another question that to ponder on is, could it be that maybe he was looking at his risk graph over here, knowing that he was in a loss situation in reality, but that he just kind of got lucky with these 4 contracts filling at $1.20 for a profit, and he just said, sweet. Something else that is kind of attached to this is the fact that, remember, his trade plan was to shut down half of his positions, half of his spreads at 50% of the original credit received at $1.20. But he closed down the entire position. So why would he close down the entire position unless he realized that the entire position was at a loss anyway? So it's possible that he could actually have been looking at this and saying, yeah, I realize I got a crazy fill. That makes no sense, but it's in my favor. So, hey, sweet. But plenty of things already that you can see here that are mistakes along the way. Now, to get into the specifics of the 6 call credit spreads over here, remember, just by looking at that risk graph, which is this guy over here, we can see there's really no point shutting this thing down. You were just like $1,000 to $2,000 away from max loss anyway. When the market is crazy volatile, bid-ask spreads are wide. No point risking trying to get out of this because you're already pretty much at max loss. If SPX were to come down, you could reduce your losses or potentially even make some money if it comes back down below this particular level, if that were to happen. Which wouldn't be that unusual, right? After a big move day, it's not unusual to then have a bit of a pullback. But look at what happened here. So he's then going through, and since he's legging out of these 6 call credit spreads, we go from a situation where the max risk per call credit spread was $32.60, like we've looked at before, right? Remember, it's basically just 35 points wide minus a credit received, coming through to a net of $32.60 of max risk that he can take per spread. And yet by legging out, he got filled at 153 on the shorts and at 91.30 on the longs. That is a loss of $62.20 per spread. He pretty much doubled his loss by legging out of the call credit spread. And the reality is that he could have literally have done nothing on these 6 remaining call credit spreads and just let them expire, and that would have expired at this max loss here. Yet by legging out, he literally doubled the loss that he took by legging out over here. And this is of the 6 that were remaining. Okay, we're not talking about the trade bust yet. Prior to him closing it out, remember that on his platform, because he was filled at $1.20 for these 4 that he basically put on, right? His potentially looking at his platform, and his platform is saying that he's actually up money. But let's actually look at what happened over here exactly. So this is the P&L he thinks he has, based on the crazy price fill for the 4 at $1.20. So he originally sold. So first of all, with the 4 short calls, right, that he got a partial fill on, he originally sold these for $5.91. He bought them back, he thinks, for $1.20. At least that's what the platform is telling him at the time. So that's a profit of $4.71. Just the difference between these guys over here per contract. He's got 4 of these contracts because we're dealing with 4 calls. Contract multiplier of 100. That basically means $1,800 or $1,900 profit on those 4 contracts. Okay, but then he's got an additional 6 short calls because he originally had 10 call credit spreads over here. So he is now, remember, I'm now talking about his actual order here of him now closing out this for $153 each for the 6 remaining shorts. Okay, so he originally sold them for $5.91. He bought them back for $153.50 each. That's a loss of $147 per contract on 6 contracts. After the contract multiplier, that comes to a loss of $88,000 on the just closing out these additional 6 shorts. Okay, but then he goes and he manually closes out his longs. Again, just to prove it, the screenshot again shows you that he's closing out the 10 longs for $91.30. So he originally bought them for $3.51. He then sold them back out over here to close at $91.30. You do the math of what the profit is over here, and that's a profit of 87. Let's round that up to 88 grand for those longs. You could see that this and this pretty much net out, pretty close. And then he had like a small profit over here. So overall, add all of that up together, he's got a small profit of about $1,000. This is what he thinks he has in his account at the time. Okay. And I went through in Optionator Explorer and I basically did exactly the same thing. So you saw it. We originally traded the 10 call credit spreads at the prices that he mentioned. He then gets a partial fill for $1.20, which I hard coded into the price over here to simulate that. And then also hard coded his actual fill price over here for buying back those 6 short calls, and then the actual price for buying back or closing out the 10 longs at the back. And then if we look at the report and we add the commissions to the realized P&L, you can see that over here matches the number that I had over here, which confirms that all of this math is correct. Okay, but it's essentially, let's just call it more or less a bit of a, let's just say a scratch trade, right? He's out for like $1,000 or whatever, made a little bit of money as far as he thinks on his platform at the time prior to him realizing that the trade had been busted, which happens in a little bit. So next day, based on information from Dell, as reviewed on multiple videos, he then says that the next day, 5 minutes after the open on the next trading day, he gets a voicemail from Schwab, which is his broker, and they tell him, by the way, I need to take one step back here. His commentary in his videos was that he thought everything was fine from the prior day. In his commentary, he never says that he was freaking out because he thought, something was wrong or anything like that on the prior day, which makes you think that, again, he wasn't looking at the risk graph potentially. He didn't realize that the real pricing for those 4 initial contracts that he got a partial fill from was at a ridiculous price. He basically thinks, he was out for more or less scratch and everything's cool. Okay? So next day, 5 minutes after the open, he gets a voicemail from Schwab, and Schwab is now informing him that the exchange, because the exchange over here is CBOE, the exchange informs the broker, in this case it's Schwab, and then Schwab informs Dale. So 5 minutes after the open, Schwab over here informs Dale that CBOE had informed them, Schwab, the prior night, and this is, I'm literally quoting Dale here. He says that the voicemail said that the prior night, CBOE had informed Schwab, and now 5 minutes after the open on the next trading day, Schwab is informing him. This is important, by the way, because this is a lot of the stuff, again, that's going around saying, oh, how dare CBOE and how dare Schwab and they screwed him, blah, 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 right? This is exactly the data now that we're looking at in terms of when did all of this kind of happen and how. So the voicemail over here says that essentially the partial fill that he got had been busted. So the $1.20 price over here on the 4 contracts had been busted. And remember, busted simply means they wipe it as if the trade never executed in the first place. So if you originally had 4 short calls and then there was a trade over here to buy back 4 of these calls over here, this is the thing that got filled at $1.20. CBOE then acknowledged this price made no sense whatsoever, so they bust the whole thing, and therefore this comes back to life. So even though he thought he had closed out all of his position manually, more or less for scratch, basically for about $1,000 profit, the next day he's told, oh, by the way, your account traded as if you left 4 short calls on at 51.35, with the market having screamed higher, and now that option having expired deep in the money. Therefore, that option got assigned. And since SPX is cash settled, it's settled to cash. It basically means you now owe us money. So this is what I'm talking about here. So the 4 short calls over here come back to life because the trade that closed them out got nullified, got busted. And therefore, Dale's account was left with these 4 short calls being there. SPX ended up closing at 54.57, which is 322 points in the money. And that contract had a value of $291 dollars per contract over here. And on those, multiply that by 4, then by 100 by the contract multiplier, and his account is now down 100 grand because of that, right? Because of 4 short calls at 51.35 having expired 322 points in the money, and him then getting assigned on that. This is what that would have looked like. So this is the example of the 4 short calls at the price that he originally traded them at the very start, okay, as if they had not been closed down, and then having expired. This is where SPX closed on the prior day, and you can see that he's basically looking at $115,000 loss on that because he got assigned on this. The other thing to note is, notice this is unlimited risk to the downside. So had SPX gone up through to here, then his loss would have been $260,000. Okay? And this is another big point of what Dale is communicating in terms of, an injustice or what have you, because remember, he had a trade that kind of looked like this, which had fixed risk, and then based on what eventuated, he's now looking at an unlimited risk trade in his account because of the trade bust. Before we looked at the P&L that he thought he had in his account. So now, after the trade bust, let's have a look at what his account actually looked like. And these two over here are exactly the same, because this is the stuff that he did manually. So really the only thing that changes is this top part over here. So clearly he did not get filled for $1.20, that got busted. So what ended up happening was that he originally sold it for $5.91. He then got assigned at $291.90. And you then do the math of, figuring out what the loss is by subtracting those two, multiplying that by the number of contracts, multiplying that by the contract multiplier, and that gives him a loss over here of $114,000 on the 4 short calls. You then add it through to these guys, but again, these guys more or less almost net out. So the loss ends up being very close through to what we saw, which is the same as what we saw back here, right? $115,000 loss. So that is exactly what ended up in his account, and the broker is now saying, you owe us 115 grand, okay, which he's got to pay. And they took, right? They don't ask, they just take. Now, how is this likely to have happened? In terms of the $1.20 price getting filled, okay? There are multiple ways it could have happened, but this is likely to have been the way that it happened. So we're starting off in a point in time here where we've got the bid and the ask. The bid and the ask over here is 17.4 by 2050, and that gives us a mark price over here of 18.95. Now, Dale then, after he got his 10 call credit spreads filled, he then puts in a limit order to close those 10 short calls at $1.20. So since he's put in a limit order, then his order gets put into the book. Okay, so way over here, there's now a bid that he's putting on for $1.20. Now, it's not the best bid. The best bid is this one over here. Okay, and the best ask is this one over here. So when you're looking at your option chain, this is what you're going to see. But if you could see the entire book, you would potentially see every other cheaper price that everybody's entered in through to their platform, which then ends up rolling up through to the exchange, essentially. Okay, so the book would show all of these other bids at lower prices over here, but the best bid over here is currently at 17.4, and that's what you would see normally in your platform. But the order is there. Now, let's think of a scenario where we've got another trader, not Dale, but another person, and that other person is bullish on the market, let's just say. So they simply buy an out-of-the-money call, a long call, okay? So they buy a long call with the expectation the market's going to go up. But let's pretend that they're also doing 0 to DTE, and they say, well, but I want to protect myself. So in the instance that I'm wrong and SPX comes down, then I want to put on a stop or a trailing stop of some kind. So in this case, what we're going to imagine is a scenario that even though the current mark over here was 18.95, we've got a trader over there that wants to protect their long call by placing a stop or a trailing stop order linked to mark, but a mark that is lower, which basically means that SPX is coming down. Okay, so let's pretend that they set that at 14. And this is an example of how you would do that, right? So you basically go in, you've already got a long call there, and you now put in a sell to close order at a stop of 14, but linked to mark here. All right, all looks pretty normal. Now, what likely happened is that for a period, and this can be validated through the actual the data feed. I think I've got a screenshot later on that shows that. But there was a very brief period here of just 150 milliseconds where these bids over here basically disappeared. So even though the market makers are normally there, providing liquidity, blah, blah, when things go crazy, there can be small gaps. Okay, so for a period of 150 milliseconds here, these bids basically went bye-bye. They're gone. So what happens next? Well, remember, there's potentially other things in here behind this particular price. In this instance, it looks like they weren't. And the only other one that was there was Dale's order. So now what happens is that Dale's bid becomes the best bid. And now the bid ask goes from $1.20 all the way up through to 2050. Let's just say that this over here didn't change. But what's happened to the mark? The mark is now at $10.85, which is just the midpoint between these 2 points over here. But now, since the mark has dropped down below 14, this now triggers that other trader's stop order. And he's got a stop market order. It could be a trailing stop or just a standard stop. It doesn't matter, but it's basically just a stop. But it was linked to mark. So now that the mark is less than his trigger level, it now triggers a sell order at market for his particular option. So from this other trader's perspective, if he wants to get filled at market for a sell, he's basically going to get filled on this one over here. And that then ate up Dale's bid. And that's how this could have likely eventuated this scenario where his bid price of $1.20 got hit by having the trader on the other side over here hit that due to this kind of scenario over there. Now let's look at this from both of those traders' perspective. Now from Dale's perspective, Dale had this profit-taking order at $1.20, and the reality is that the real mark price should have been somewhere around, say, 17. Okay, but since the market maker bids disappeared for just 150 milliseconds, this order ended up getting eaten up. So from Dale's perspective, is Dale happy? Well, remember, Dale was in a scenario that he sold this originally for $5.91, and he can then buy it back for $1.20. He's super happy. He's made a profit of like $1,800 on that position. What about the other guy, though? The other guy over here had purchased a long call at some particular price over here, and then he's being forced to have to sell that at a ridiculously low price. Is that trader happy? No, they're furious. Okay, so that other trader got hurt badly, whereas Dale's fill on this particular position helped him. Dale is super happy with this ridiculous price. It's a ridiculously cheap price that works against the trader on the other side of Dale, whereas it worked in Dale's favor over here. And this is going to be important when we look at rules. Let's touch on this one. So, screenshot from one of the videos. Over here it's saying, the busting of the short closing from CBOE changed his defined risk to unlimited risk. So he's basically saying he put on a call credit spread that had a defined max risk over here. This commentary over here, which is also what Dale is saying multiple times in multiple videos, that due to the bust from CBOE, they essentially changed this risk profile to a risk profile that looks like this, with an unlimited risk scenario. Now, is that true? Answer is no. They did not do that. It resulted in that, but only due to the fact that Dale had configured a profit-taking order just on his shorts. Had he put on a profit-taking order on the spread, then, and I'll prove this to you with a screenshot later on, CBOE cannot bust an individual leg of a complex order that's been submitted as a single trade. So if you submit a call credit spread, that cannot just bust your short call and then say, tough luck. Therefore, the morph from a call credit spread in through to essentially a short call type of risk profile, which is unlimited upside risk, was due to the fact that his order to close out his trade was only on one leg. So this concept over here is actually false. This is another quote, all right? So time index over here, 440 from the Theta Profits video, different video. Actually, it's the same dude that you saw back there. But anyway, he said, this is Dale speaking now. He says, had I kept my original position, and this is my comment here, basically he's suggesting if he had not been busted, okay, if that trade had not been busted, then his max risk would have been $13,000. Is this true? Absolutely not, okay? Because that ignores the fact, so yes, he would have had a $13,000 max loss on the 4 call credit spreads, but he was trading 10. So this commentary over here ignores the fact that his 6 other call credit spreads were pretty much already at max loss. So his loss would have been much bigger, okay? So the reality is, had he not been busted and essentially not done anything, he would have had a loss of $32,600, not 13. Right? So that's wrong too. So I've shown you this already with 6 call credit spreads at 12:30 p.m. Central Time over here. Basically $16,000 loss. But again, this assumes you could trade on the mid price. Then with some slippage, you're basically going to be somewhere down here. If you were to try to manually close out that particular spread. But why close it out, right? You're already like $2,000 away from max risk. Ideally, you should really just leave that position on. Especially if you're looking at a risk graph, it's obvious just by looking at it. What if he had been notified of the trade bust prior to the close? And this is the screenshot that you can see here where it's showing you this particular code here. It implies the a trade bust being published onto the feed. But then by looking at the milliseconds of the day, you can then figure out what the actual timestamp was, and that's approximately 34 minutes before the end of the trading session. Now, this could potentially be useful to some degree to Dell in the sense that he's being informed of the trade bust the next day, 5 minutes after the open. Whereas there's data in the feed to show that 34 minutes prior to the close of that same trading session on the prior day, the feed showed the bust. So the ideal situation would have been that CBOE informs Schwab as soon as this is official, which basically is 34 minutes prior through to the close. And then Schwab informs Dale 1 or 2 minutes after that. Via email, via voicemail, by some means. Okay? So this is potentially useful from that particular purpose if you want to try and escalate the issue and say, look, there's proof that 34 minutes prior to the close of that same trading day, the feed showed the actual trade bust. So why the hell wasn't I informed at that point in time? But let's look at that. Let's pretend that that exact situation happened, and that we'll now go through to 30 minutes. Let's assume that it takes 1 or 2 minutes for each of those communications to happen, right? From CBOE to Schwab, and then 1 or 2 minutes from Schwab through to the customer. So let's say that Dell can now hop back on 30 minutes prior to the close and see how that would have looked like. Now, these two things down here are exactly the same as before because he manually did these changes, right? All we really care about over here is the trade bust. So from a trade bust perspective, he originally sold the call for 591. Then at half an hour prior through to market closing for SPX, the mid price over here, and I'm going to be nice and select the mid price instead of assuming any kind of slippage. Okay, so the mid price over here was 284. You then do the math. 4 contracts over here, originally sold for 591, then bought back for 284. Contract multiplier, $111,000 loss. Okay, overall, his loss was 112 over here. So what's the difference between those two? So his position as happened, which means, getting informed at 5 minutes after the open the next day, being informed of the fact that his 4 short calls got assigned from the prior day because that expired because it was a 0 DTE trade. He was down essentially $115,000, which is the reality that he suffered, right? He lost that amount of money. Had he been informed promptly, or even more promptly, let's just say, he could hop back in through the market 30 minutes prior through to the market closing on the same trading day. He would have been down almost the same amount of money. Okay, so would it have been ideal for him to have been notified? Sure. The quicker the better. I think we can all agree on that. But the reality is that even if he was, he would have been down the same amount of money. So in his case, it would not have made an ounce of difference between the two, had he been informed more promptly than what he was. So let's have a look at specific screenshots from the official PDFs that they put out. So this is the concept of, if you trade a complex order as a single trade, such as, say, a call credit spread, where you're putting it on as a call credit spread, can the CBOE bust just one of the legs? And you can see from here, it basically says, if any leg of a complex order is nullified, the entire transaction is nullified. So if you put on a call credit spread, can they bust a call credit spread? Yes, but they bust the entire call credit spread. They cannot bust just the short or just the long of a call credit spread. If you're trading, some kind of broken wing fly, and you've entered the order as a broken wing fly, can they bust just this little short over here? No. They could bust the entire thing, sure, but not one of the legs. What if you're doing something like you've got a broken wing over here, and then you've got a calendar or diagonal above the money. The market is currently here. Can they bust an individual leg? No. But when you're putting on this trade, you put on this trade with two orders. You did the broken wing fly first, and then as a separate order, you did your calendar or diagonal. So they can bust an order, a complex order. They can't bust an individual leg of a complex order. So even though they can't bust the individual short or long of any one of these particular orders over here, they can bust the entire complex order. You might be thinking of this as, well, this is my trade. My trade is a combination of these two things. But what you've got to understand is that you're putting on this position in two trades. And you need to understand that a complex trade entered as a single trade can be busted, but not an individual leg of a complex trade. Right? So, and this again is proof which goes against the claim being made by Dell and by some of the people doing the reviews, saying, how dare the CBOE do such a shocking thing, which is to cancel or bust the leg of a fixed risk trade and convert that into an unlimited risk trade. They did not do that. What they busted was his individual order to close out the shorts, which he manually entered. Had he placed an order to close out the call credit spread as a spread, worst case scenario, they would have busted the spread, and he would have had 4 of these call credit spreads come back to life, where each one of these 4 call credit spreads would have had a $3,200 max risk, but also risk defined. Yeah, and this is basically going to that. So what if the 4 call credit spreads had been busted? So I'm just splitting out the 10 call credit spreads over here into chunks. So in the instance that 4 of these call credit spreads, this is the profit taking order, right? But if he had placed this profit taking order as a spread, then these guys basically come back to life. And just as I mentioned, each one of these spreads has a max risk here of $32.60 each, which is a total of $13,000 max risk. These 6 call credit spreads over here have a max risk of 19.5, and as we saw at the start, the 10 call credit spreads have a max risk of 32.6k, which he seems to have been willing to take that risk when he put on that trade. But again, the key is, had he exited as a call credit spread, they could have busted that call credit spread, but not an individual leg of the call credit spread, converting it from fixed risk in through to unlimited risk. Now, can Dale request a trade bust? Had he noticed in time, for example? That is one question. The other thing that you see Dale mentioning, specifically in the videos, is that he says the other person on the other side of the trade was more powerful than me, had more money. They probably were members of CBOE and all that kind of stuff. And so therefore, CBOE decided to give that particular trader the bust instead of giving it to me. How unfair, how unjust. Well, let's look at the rules here. When we look at the erroneous buy or sell and how that particular thing works, you could see over here, based on a screenshot from their PDF, an erroneous sell. Remember, this is for the guy at the other side of Dell's trade. So for an erroneous sell is if the price received for the person selling over here is erroneously low, and in the case of an erroneous buy, it's if the person purchasing is purchasing erroneously high. So in other words, what that means is what I've said here. So if you're a buyer, if you're going to then because of a mistake, have to pay a crazy high expensive price, you're being hurt. You're not paying a fair price, you're paying a ridiculously expensive price as a buyer. On the flip side, if you're a seller, then if you are essentially forced into a transaction where you're getting an unfairly cheap low price for that, then you're being hurt. Now, from Dell's perspective, he's actually on the other side of that, because he's a buyer. Remember, he was looking to buy to close his short calls, so he's essentially a buyer. Was he paying a crazy high expensive price? No, he was paying a ridiculously low price of $1.20. What about the person on the other side of that trade? The person on the other side of the trade was a seller of that call, and from their perspective, they did have a ridiculously low, cheap price that was very unfair at just $1.20. The fair price for that was like $17 plus. And yet they had to eat $1.20, which is unfair. So the other guy got hurt, not Dale. Dale benefited from this. So the reality then is that the trade bust could only have been placed by the other guy, not by Dale. Okay, the rules say that even if Dell tried to submit for a trade bust, it would have been declined. Okay, he's not the one that's being hurt. He's the one that's benefiting from this. So it's got nothing to do with, oh, the other guy was more powerful. Oh, the other guy, it's, CBOE is just, meandering and pandering to their friends and all this kind of stuff. No, they're just following the rules. Dell was not hurt by this. By the way, I should clarify that. Dell was not hurt by the bust of this particular transaction. He was hurt by the net effect that caused, the domino effect of the fact that he then manually closed out all of his other positions, and then he was left with those 4 short calls, and therefore he was hurt because he was unaware of this thing happening. I get that he was hurt for sure, okay? But with this specific transaction of 4 long calls over here from Dow's perspective, or from the other side of the trade, 4 calls being sold by the other guy, it was the other guy that was hurt by this transaction, not Dale. So these rules are there to protect the person getting hurt, and it was the other guy, not Dale. Had Dale realized that he was getting a crazy good fill at $1.20 for something that made no sense, because remember, that option should have been somewhere priced between $17 and like $100, okay, depending on what minute or whatever you were actually checking the actual chain. He should have called the broker and said, look, this looks totally wrong. And then the broker at that point would have gotten involved, and then the trade would have been busted. But the point is that it's being busted in order to protect the guy on the other side of the trade. But at least Dow would have, at that particular position, been informed or have had a little bit more information to do something about it, even though, like I've shown already, he was already pretty much almost at max loss anyway. So there's pretty much nothing he could have done, even had he known before the fact, just because he was trading 0 DTE and there's no time to do anything. The whole point here is that the rules are there to protect the person being hurt. And in this case, Dell was the one that was benefiting from this price. And it was the other guy that could be the only one to validly log a bust, because he was being hurt. Getting into a little bit of the technical stuff over here, but in terms of the theoretical price, CBOE is always going to calculate the theoretical price in order to then figure out, let's just call that, what is the current fair pricing, and from there, in order to look for potential trade busts, they then have buffers, price targets essentially, that go from the theoretical price through to anything that goes beyond that particular buffer, one way or the other. That's how they then know if it's going to be an erroneous trade. Okay, now you can see here they're basically saying the best bid over here just prior to the transaction in question with respect to an erroneous sell transaction is what is going to be chosen as the theoretical price. Now remember, we're now looking at this from the person requesting the trade bust, which is the guy that's on the other side of the trade from Dell, who's a guy who's essentially selling that call. And this is the trade that was eventually busted. So if we then look at the best bid just prior to the bust, we can see that it was 17.9, the best bid. So that becomes the theoretical price that they're going to be working with. And then from there are two types of errors. One of them is called obvious and one of them is called catastrophic. So the obvious errors, there's a sliding scale over here that says from the theoretical price, what is the minimum distance one way or the other that it can go before we will call this thing an obvious error. So in this case, if we go with a price of roughly about $17 over here, it's saying that it would have been classified as an obvious error with a move more than 0.8 from the theoretical price. And for an obvious error bust to be logged, you've got to file this with the exchange within 30 minutes of the execution. Okay, so you get what you think is a bad fill. If it's beyond these kinds of limits for whatever price of the option you're originally trading, remember the theoretical price, the fair price, right? Prior through to the weird one, then at that point you've got to log it within 30 minutes if you want that busted with the exchange. And then you've got catastrophic errors, and catastrophic errors basically just means that the buffer over here is going to be quite a bit bigger than the buffer we saw before. And again, if we look at 17 here with the option, the actual theoretical price for the seller, if it's more than 2 points away, in this case, if it's less than $15, then it would be classified as catastrophic. In this case, it was $1.20, so it definitely would have been classified as a catastrophic error. If you're inside regular trading hours over here, you can see that it says notification must be received by the exchange by 8:30 a.m. on the first trading day following the execution. So that's not 30 minutes. That you could literally go through to the end of the trading day and then overnight, and then as long as you log it before 8:30 a.m. the next trading day, it could be busted at that point. Then if it's in global trading hours, just think of that just as, extended trading hours there. Notification must be received within 2 hours of the close of that global hours session. And in our case, this is the one that's most relevant. And it says for transactions in an expiring options series that take place on expiration day, this is a 0DTE trade, so therefore it matches this. The party must notify the exchange within 45 minutes after the close of the regular trading hour session on that same day. Okay, so what this is saying is that your trade, if you're trading 0DTE, your trade can be busted 45 minutes after the close of the regular trading session, which is not ideal, right? Because the option has already expired. There's nothing you can absolutely do whatsoever. And then, say 30 minutes after the regular session closes, you're then informed, oh, by the way, this thing was busted. Now, time limit for a trader requesting a trade bust. We've already seen that there was a 30-minute thing, but this is just extra confirmation here. Within 30 minutes of the execution, you have to file that. This is from the exchange rulebook. You can get there, page 410. And then if you then even check on the Schwab documentation over here, you can see they pretty much say the same thing in terms of 30 minutes here from the execution time is where your time limit as a trader to request a trade bust. Now, let's flip that and look at that from the other perspective. So now once a trade bust has occurred, remember the trade bust happens by the exchange, not by the broker, right? You as a trader, you inform the broker. You don't have the ability to talk to the exchange. You inform the broker and the broker informs the exchange. And then on the way back, once the trade has been busted, CBOE does not talk to you directly, they talk to the broker. So the first thing is understanding what is the time limit of the notification going from CBOE to Schwab in this particular case. Well, all the documentation says is that the exchange, CBOE, shall promptly notify both parties to the trade electronically or via phone. There is nothing in the documentation that says anything more specific than that. So therefore, it is subjective. So prompt to you may not be prompt to them. Prompt to them might be, hey, next day, should be fine. And they can consider that prompt, right? Now, in the case of Dale's own commentary has said that when he received the voicemail from Schwab the next day, Schwab said in the voicemail that CBOE had notified them the prior night. And then the broker, Schwab, then informed Dale 5 minutes after the open, the next trading day. So that's interesting, right? The fact that there is nothing beyond them just saying promptly, whatever the hell that means. So they have flexibility there, in case anybody tries to sue them or anything like that, I guess. Yeah, so this commentary here is basically just saying that there was really nothing he could do had he been notified even 30 minutes prior to the close, as we've seen. We've already seen the math. The loss would have been almost identical in Dell's case. Okay, so can he complain or try to sue or something like that, saying, hey, you guys should have notified me roughly 34 to 30 minutes on the same day, since the bust had already been published onto the feed. So can he try to pursue Schwab or CBOE? Maybe. The problem then is that when they then look at the data, that they then get to see that even had they notified him even more promptly, the damage was already done in his positions. Okay, so there would have been no benefit because he would have had pretty much the same loss. So therefore, I don't think he's got much viability in pursuing that at all. All right, but even with the notifications that happened here, where CBOE informed Schwab overnight, whatever overnight means, they can consider that to be prompt, and therefore they're completely within guidelines. And then for Schwab to then have their staff come in at whatever the time they come in the morning, which I assume is just prior to the open, and then inform Dale 5 minutes after the open, that seems reasonable too, in terms of promptness, if you like, from the broker through to the actual trader. Okay, so basically, I don't see any issue necessarily with the bust itself. There was no issue with the notification from CBOE to Schwab, no real issue from Schwab through to Dell, even though that could be improved for sure. Rumors are that with interactive brokers, their notifications are more prompt than what you find with Schwab. So that can be improved, but unfortunately in Dell's case, we get back to the point that even if he had been notified, it would have made no change to his P&L. So getting back through to Dale's commentary here, his exact quotes, I've logged the reference if you want to see it for yourself. He's basically saying, CBOE's busted trade rules, especially Rule 6.25. By the way, there is no Rule 6.25. There is a 6.2. So that's just a misspoken thing. Anyway, if CBOE's busted trade rules were created to protect market participants from clear errors like fat finger trades or trades occurring at prices far from the market. All right, so now you know exactly how this is qualified. So first of all, you now know how to look at the theoretical price. You now know the difference between an obvious error versus a catastrophic error. You can look at the table to see what the actual gap or what the distance is between those two. And you know the exact way that you got to proceed in how much time, 30 minutes, that you need to log that particular trade bust. Okay, and then also how the notification comes back through to you. But that is qualified. It's not just, saying it's got to be far, right? You need to be specific, and also remember it requires that that you're being hurt by that transaction. Because remember, in Dell's case, he was benefiting from this, so the bust is not going to work from his perspective. Okay, the seller is the one that is being hurt. So the idea was to prevent investors from being unfairly harmed by outlier trades that never should have happened. True, that part. But here's the problem. When CBOE applies the rules to bust a limit order that was filled correctly, it can unintentionally harm the investor it's supposed to protect, especially when the trade is part of a multi-leg defined risk strategy. This is the part that, again, he keeps talking about and is incorrect. CBOE cannot bust an individual leg of a complex trade. That was his own doing in submitting an order to close out just the shorts of a call credit spread. In these cases, cancelling just one leg of a filled spread exposes the trader to unlimited risk they should they never consented to. Again, false. Right? Had he had an order to close the call credit spread, they could have busted the call credit spread, but not bust an individual leg of a trade and therefore turn a fixed risk trade into an unlimited risk trade. That is wrong. More comments here. I placed a multi-leg option trade with defined risk. You can see where he's going. My order filled. I saw it in my account. I made decisions based on the fill. Hours later, without warning, the exchange erased part of that trade. No. Leaving me exposed to massive risk I never agreed to. Wrong again. Then they waited to tell me about it until the next day after I could do nothing about it. Also wrong. They did wait until the next day, which is within normal boundaries of the notification criteria based on the rules, both from CBOE to Schwab and from Schwab through to him. And on top of that, as I've already mentioned multiple times, even had they notified him 30 minutes prior to the close, his P&L would have been the same. Still the same amount of loss. I didn't make an error. He made multiple errors, so that's wrong. I followed the rules. No, he didn't understand the rules. But now I'm paying the price because the system meant to protect me failed to understand its own ripple effects. Also wrong. He was the one that didn't really understand how things worked. I think the person on the other side of this trade was more powerful than I was. We've talked about this. That's incorrect. It's simply a matter of the fact that he wasn't the one that was being hurt by that wrong price of $1.20. The other guy was, and therefore that other guy can submit the bust, not him. I've contacted my broker Schwab. They're currently evaluating my case, and I'm hopeful that we'll reach some resolution. So far, I've heard mostly it's not our fault. The CBOE busted your trade, and we told you as soon as we found out. That seems to be accurate. Which was, by the way, the day after I hit the ground from the parachute jump. Again, he's complaining he was notified late. In other words, it was too late to prevent any of the destruction. Wrong, because had he been notified 30 minutes prior to the close, it would have been the same loss, pretty much. This is unfair, and injustice has been done to me. No, he just didn't understand the rules. All right, summary of the mistakes. Key, taking a profit-taking order on an individual leg rather than at the spread level. This was really the first domino that the other stuff followed on to damage his account. That was done by him, not by CBOE. His trade plan over here was again to take profits on half of his spreads at 50% of the max credit, yet he placed an order to close all 10 shorts at a price of the spread and not the individual leg. And that is kind of related through to the first thing that we talked about before. The fact that he had this order on a single leg, that is what then caused the trade bust to, in his instance, give him what he thought was the conversion from fixed risk to unlimited risk, but it was really not, as we've talked about. I already talked about the rest there. Okay, mistakes number 2. Either he was not monitoring the risk graph of eyeballing this, which clearly shows that he's at a big loss, and also shows that the actual price over here was much, much, much higher than $1.20. So either he's not even looking at this and not looking at this, which in itself is kind of crazy, right? To not be using very valuable information over here that can visually tell you what's going on. And he remains unaware that there's any issue whatsoever until the next day, which is what he claims, right? In his videos, he says, I didn't know anything was wrong, until the very next day. Okay. So either that, or he was looking at both, and even though he realizes he's taking a loss, he then says, oh, geez, I better shut down the entire position now. And gosh darn, I'm so lucky that I got 4 contracts filled here at $1.20 for a profit instead of a really big loss. Lucky me. That's an issue too. Because, again, ideally he should have contacted the broker at that point and said, look, this is crazy. Even though he realizes he can't bust the trade, he's at least letting the broker know, and then the broker can submit the bust on behalf of the person that is being hurt, which is the guy on the other side of Dell's trade, so that the trade ends up getting busted anyway. But remember, Dell does not have the right to bust it. Okay? The bust is to protect the person being hurt, which is the other guy. And third, then he's going in there, and remember, after he got the partial fill for the crazy price, he manually put in an order to close the 6 calls at the same strike for $153.50. How can this not scream to you something's wrong? Anyway, so it's either that he didn't notice, which is kind of concerning in itself, or the likely scenario, I think, is that he said, sweet, awesome. He did realize that it was at a crazy price, but it's in his benefit, so happy days. And 4 over here, again, the 6 remaining call credit spreads after the partial fill, it was crazy for him to, remember, just by looking at a risk graph, you can see that you're already pretty much at max loss, so there's no point closing them out in the first place. You know that by closing it out, you're really just going to be closing it at max loss anyway, so there's at least a chance that the market can kind of come back down, and maybe your losses could be reduced or even nullified if you're lucky. But at worst, you know that 32.6k loss that you jumped into at trade creation with open eyes, knowing that that was your max risk, that is going to be your max risk instead of $115,000. But by then making things worse and then legging out of those 6 call credit spreads, he then doubled the loss that he ended up taking on those 6 remaining call credit spreads. Doubled it. Okay, so that was another big mistake there. Last one here. When the prior day VIX closes at 52.3, market's wild, bid-ask spreads are crazy. If you want to snort cocaine and then go, walk on a tightrope with shark-infested waters underneath you, good luck. Know what you're doing. You got to watch this thing like a hawk when you're trading 0 DTE. So, if you want to play in that, high stakes, high energy, eyeballs glued to the screen world, do it. But just know that you're taking significant risk doing that.